We will now begin discussing the solution to exercise 6-14, working with a segmented income statement on page 260. This problem involves a company, Marple Associates, which is a consulting firm that specializes in information systems for construction and landscaping companies. What we have is segmented income statements in the contribution format for both the Houston office as well as the Dallas office, and then the total company contribution format income statement. In requirement number 1, they want to know how much would the company's net operating income increase if Dallas increased its sales by $75,000 per year. They assume that no change in cost behavior patterns has occurred. As you can see here in the solution, if sales revenue would increase by $75,000 per year in the Dallas office, there would be an additional $30,000 of contribution margin. How we know that is that if you take 40% of $75,000, 40% being the contribution margin ratio for the Dallas office, as listed on page 260, multiplied by 75 grand would give you an additional $30,000 of contribution margin. This additional $30,000 is the solution to that answer. Part 2 says, go back to the original data, and it says, assume that sales in Houston increase by $50,000 next year, and that sales in Dallas remain unchanged. Also, assume that there's no change in fixed cost. They want us to prepare a new segmented income statement for the company using the above format. If you scroll down to Part 2 of this solution, you would see that increasing the Houston office revenue by 50 grand would bring it to $200,000. Assuming that the contribution margin ratio is still 70%, they did not tell us it changed, we would therefore have contribution margin of $140,000 and segment margin of $62,000 after subtracting the traceable fixed cost of $78,000. Overall, the company's segment margin would be $212,000. Net operating income would increase to $92,000. Part B of this number 2 said that observing the income statement you've prepared and the contribution margin ratio for Houston has remained unchanged at 70%. But the segment margin ratio has changed. If you notice, it's gone up to 31%. As originally stated in the book on page 260 was 18%. And they want us to explain the change in the segment margin ratio. And basically, the segment margin ratio has risen as a result of the rise in sales, and also the fact that fixed costs have remained the same. These fixed costs are spread over a larger base as the sales revenue has increased. The contribution margin ratio is stable as long as there's no change in variable cost. However, the segment ratio will increase as a result of increased contribution margin, assuming that there's no change to the traceable fixed cost. Therefore, that is the result or the difference that we see from one segment margin statement as listed in page 260 to this solution in the book. This concludes our discussion of exercise 6-14. Welcome back. Now we are going to discuss problem 6-19 on page 263. Problem 6-19 deals with segment reporting and decision making. In this problem, we have a company named Reston Company, and we have an income statement for the month ended May 31st. This income statement is already presented in a contribution margin format. As you can read on, it says that management's disappointed with the company's performance and is wondering what can be done to improve profits. So the company is then examining their sales, cost records, and you've determined the following. Number 1, the company has 2 sales territories, Central and Eastern. And what they first have us do in Part A as well as Part B is they first have us prepare 2 different segmented income statements. The first one asks us to segment the company based on territory. So they go through and give us information for the Central Territory. They give us their sales and their variable expenses during the month of May. And then they also tell us that the remaining sales and variable costs relate to the Eastern Territory. They give us fixed cost for each of the territories of $160,000 for the Central, $130,000 for the Eastern. They tell us that any remaining fixed costs are common to both territories. Part B then asks us to go ahead and take the Central Territory, which we'll talk about in a little bit, is the weaker or weakest performing territory, and breaks it out between their two products, Alls and PALS. And basically they give us further information as to the sales for each, the variable costs for each, as well as the fixed costs which are traceable to each. So Part 1 says to prepare contribution format income statements for the Central Territory as well as the overall company. So if we go to Part 1 here, we see that based on sales territory, we have the Central, we have the Eastern. Just using the information that they've given us in the book, we have sales revenue of $400,000 for the Central. They tell us variable cost is $208,000. Therefore, the contribution margin must be $192,000. They tell us that the Central Territory has $160,000 of traceable fixed cost. Therefore, they have segment margin of $32,000. The Eastern Territory, they tell us, has $500,000 of sales revenue, $200,000 of variable cost, $300,000 of contribution margin, $130,000 of traceable fixed cost, leaving us with $170,000 of territorial segment margin for the Eastern Territory. Overall, the segment margin is $202,000. Subtracting from that the remaining common fixed cost of $175,000, we have net operating income of $27,000. The next segment margin that needs to be prepared is given to us in Part B. They break out the Central Territory. If we were to look at the Central Territory, we see that it's the weaker of the two territories. So obviously there would be motivation for us to dig in and find out, well, why is the Central Territory performing so poorly? So we may then break out their income statement for that territory by product line, and maybe lying in the product line segment statements we can see which of the two products is the weaker performer, and that may isolate our problem. So by going through Part B here of Alls and PALS, we then go through and find out that Alls have $100,000 of revenue. We're told that the variable cost for that is 25% for Alls, therefore leaving us with contribution margin of $75,000. Our traceable fixed costs are $60,000 as given in the book for Alls, leaving us with product line segment margin of $15,000 for Alls. PALS, on the other hand, have revenue of $300,000. They have variable cost of $183,000, found by taking $300,000 multiplied by 61%. When you subtract the sales revenue less the variable cost, you have contribution margin of $117,000. Subtracting from that the traceable fixed cost of $54,000, you're left with product line segment margin of $63,000. One thing you should note is that the sales revenue overall for the Central Territory is $400,000. The variable cost $208,000. The contribution margin $192,000, and that is the same as what's given above. The only thing that's different is that our fixed cost is broken out between that which is traceable and that which is common to that Central Territory. So if you were to eliminate either the Alls or the PALS, you would still have $46,000 of fixed cost. All right. After preparing these two segment statements, and number 2, they ask us to look at the statement you've prepared showing the total company segment by sales territory. And they ask us what points might be revealed by this statement that should be brought to management's attention. And some of this is obvious, and obviously the 2 points that the authors of the solution manual state is that compared to the Eastern Territory, the Central Territory has a low contribution margin ratio, obviously giving rise to its low contribution margin and overall profits. Secondly, they have a high amount of traceable fixed cost. Compared to the Eastern Territory, the Central Territory is therefore a little bit more weak. Part 3 asks us to look at the statement you've prepared for the Central Territory, segmented by product lines, and asks us to highlight some information that's brought to that we can identify, then bring it to management's attention. Again, 2 points that should be brought to the attention of management. Number 1, Central Territory has a poor sales mix. Just by looking at the two products, Alls versus PALS, you can see that the Alls are a much more profitable product. 75% contribution margin compared to the 39% of PALS. However, we only have $100,000 of revenue from Alls. We have $300,000 of revenue from PALS. So if there is some way we can improve the mix where we sell more Alls than PALS, we could improve the overall profitability of this territory. Secondly, the traceable fixed cost of the Alls seemed to be pretty high compared to sales revenue, showing that this product is highly leveraged or has a high fixed cost to sales ratio. $60,000 of fixed cost compared to $100,000 of overall revenue. All right, there's a lot of risk with this product. Therefore, in times of downward sales or sales decline, it's going to perform negatively or poorly. Therefore, we need to somehow find a way to improve the sales revenue of the All product. This concludes our discussion of exercise or problem 6-19 on page 263.